If you're like most investors, you've been told over and over again to just buy and hold stocks for the long run. Don't try to time the market. Don't get fancy. Just consistently put your money into a boring index fund and everything will be fine, right? Wrong. Dead wrong. While that set it and forget it advice is conventional wisdom peddled by pretty much every financial talking head, I'm going to let you in on a controversial secret. The stock market doesn't just go up in a straight line forever. It cycles between bull markets and bear markets, periods of growth and periods of decline. Those who blindly follow the buy and hold mantra get crushed when the inevitable downturns strike. Just look at the carnage from crashes like 1929, 1987, 2000, and 2008. Fortunes were wiped out because investors were unprepared. Right now, we're in the latter stages of one of the longest bull markets in history. We had a quick dip in 2020, but overall stocks have been going up for over a decade since the last financial crisis. But mark my words, this party will end. Bull markets always do. We're undoubtedly approaching the next massive stock market crash, one that will violently shake up everything. While the talking heads continue pushing buy and hold, I'm here to show you the contrarian truth. You ready? The key to building real, lasting wealth is to actively prepare for and profit from the next inevitable market meltdown. I know, that probably sounds crazy, maybe even unethical. But stick with me, and I'll prove why the traditional strategies are nonsense designed to keep you poor. This opening leans right into the contrarian hook, directly challenging conventional buy and hold wisdom. It positions the stock market as cyclical, not just a constant upward trend, and it teases revealing a controversial secret for profiting from crashes, creating curiosity and drawing the viewer into wanting to learn more. Signs that a market crash is imminent. The writing is on the wall. We're approaching the end of this extended bull cycle, whether the mainstream experts want to admit it or not. Stock valuations are through the roof, pricing in years of wildly optimistic future growth. Price-to-earnings ratios are at nosebleed levels not seen since the 2000 dot-com bubble. At the same time, economic fundamentals are deteriorating. Inflation is raging, interest rates are spiking, and consumer confidence is plunging. Corporations are signaling harder times ahead through layoffs and lowered guidance. We're seeing the same excessive risk-taking, rampant speculation, and irrational exuberance that always shows up right before a market top. From AI mania to overvaluations, stock frenzies to SPAC companies literally printing money going public, it reeks of 1999 all over again. Mark my words, the situation is unsustainable. All the signs are there that a big correction, if not a full-blown crash, is coming. When that inevitable crash hits, it's going to be devastating for anyone trapped in the buy-and-hold mindset. Your typical 60-40 portfolio is going to get slaughtered as both stocks and bonds sell off. We're talking potential losses of 30%, 40%, maybe even 50% or more of your net worth almost overnight. A total wipeout of decades of growth and savings for many unprepared investors. And it won't just be a flesh wound that heals quickly. History tells us these crashes can usher in long, grueling bear markets that grind away investor wealth and confidence for not weeks or months but years. Just look at how many people got burned in 2008 and never got back into the market, missing out on the entire rebound. Their retirement plans in tatters because they didn't have an exit plan. This lays out the call to adventure in a gripping, reality-checking way. It outlines all the major red flags and risks building up, creating a sense of danger and urgency. The consequence of being ill-prepared is rendered in vivid terms to elevate the stakes. This primes the viewer to be open to the unconventional strategies promised. Now at this point you might be thinking, yeah, but surely the smart people at the Fed and big investment firms have seen these warning signs too. If a crash was really that imminent, wouldn't they be doing something about it? That's the temptation to ignore the warning signs. When you've been conditioned to trust the financial authorities, to believe the mainstream narrative at all times, it's extremely tempting to dismiss or rationalize away any contrarian data points. They must have it handled. The experts know what they're doing. If I just stay the course, keeping buying and selling like they recommend, it will all work out. Ignoring the horns blaring around you is the easy path. Recognizing them requires admitting that the rules you've been following your whole investing life might be wrong. And that leads us to the other major psychological hurdle, the fear of missing out on further gains. Even if your gut tells you this rally is running on fumes, it's hard to go against the herd. What if I get out too early and the bull market keeps charging ahead? I'd be leaving tons of money on the table. Better to just ride it out a little longer. Maybe you were underinvested and finally built up a decent net worth during this bull run. The idea of taking any sort of defensive action, of locking in some profits, feels like leaving the casino after your first hot streak. Or perhaps you can't overcome the innate human bias of recency, where you assume that whatever environment you've experienced lately is the norm, rather than appreciating how cyclical and ever-changing markets truly are. These psychological barriers of comfort, greed, and pattern blindness keep most investors stubbornly clinging to the same doomed buy-and-hold strategies, even as danger closes in. When the last huge market crash hit in 2008, most investors were caught completely off guard and decimated. But a few brave contrarians weren't just prepared. They rallied against the herd and made an absolute fortune. People like hedge fund titan John Paulson. While the housing bubble was still inflating, Paulson studied the unsustainable situation and made a bold bet against the market. His firm Paulson & Co. shorted billions worth of mortgage debt, generating eye-popping returns of $20 billion when it all came crashing down. But Paulson wasn't just a one-hit wonder bear. As the wreckage settled in 2009, he flipped to being aggressively bullish. He piled billions into beaten-down financial giants like Bank of America, Citigroup, and Goldman at rock-bottom prices, perfectly timing his switch to offense. See, investors like Paulson understand that fortunes are made by going against the crowd at key turning points in the cycle. They have the wisdom and mental fortitude to temporarily resist the mainstream mindset. When euphoria reigns and assets become overheated, they take defensive steps to protect their capital through options hedges, put buying, short selling, and diversifying into undervalued asset classes. Then when the bust inevitably comes and the herd is forced to indiscriminately sell, they go on a buying rampage and back up the truck, scooping up shares of solid companies at fire sale discounts from the capitulation of weak hands. It's a steady rhythm they follow, avoiding the worst burns from crashes while perfectly timing their strike to maximize profits from the aftermath, a continuous cycle of strategically shifting risk and deploying capital. This is the path Paulson and other elite investors have used to not just preserve their wealth during chaos periods, but exponentially grow it. And it's a blueprint anyone can emulate if they have the right mindset and strategies. Accepting the reality of the impending crash is the first and most crucial step, is accepting the reality that a major stock market crash is inevitable at this point in the cycle. We can't avoid it or wish it away. Quit listening to the perma-bull propaganda meant to keep you 100% long and complacent. Wake up and smell what the real data is telling us. Overvalued assets across the board, deteriorating fundamentals, and a hazardous speculative mania afoot. The music is stopping whether you like it or not. It's just a matter of when, not if, everything comes crashing back down to reality. Commit to a plan to protect and grow wealth. Once you embrace the truth of what's coming, you need to make a firm commitment to take decisive action to protect your hard-earned capital. And not just protect it, but position yourself to capitalize on the chaos. This requires checking your ego, admitting the flaws of the buy-and-hold dogma, and drawing up a whole new battle plan, one built around formulaic ways to cut risk, raise cash, and go on the offensive when the time is right. It won't be easy. This is the point of maximum psychological resistance. It means separating from the herd and facing criticism from the entrenched wolves of Wall Street. But great fortunes are made by those who can be fearless contrarians. Before we get into strategies for hedging against a market crash, if you're looking to level up your income and gain invaluable entrepreneurial skills, make sure to like this video and subscribe to the channel. With a committed go-against-the-grain mindset, now we can start executing crash-proof strategies. First up is cutting risk through hedging techniques like put option buying to provide portfolio protection, short selling overvalued bearish positions, or diversifying into undervalued asset classes like commodities. These can allow you to reduce exposure and mitigate rampant downside if the market pukes, staying tactical rather than stubbornly holding and watching your net worth evaporate. But we don't just want to survive the crash, we want to thrive in its aftermath for maximum gains. So as the volatility escalates, you need to actively scan for bargains in the wreckage to buy at generational lows. Look for stocks in solid companies with strong balance sheets that are being indiscriminately sold off to prices that make no logical sense. Analyze if their business will still exist in 5-10 years and try to get them at a 50% discount. It's about being a contrarian buyer when there's blood in the streets and the assets are priced for Armageddon. Let's take the year 2020 into account. We all know what went down in 2020 when the world stopped. People stopped traveling and stayed indoors. We saw huge companies panic, such as Avis Rental Company. They actually started selling their fleet of rental cars. Now, I believe most of us knew that the world would eventually open up again and we would be traveling again. But Avis panicked, sold their cars, and their stock went down from about $48 to a low of about $10.50 in 1 month. In December 2020, the stock steadily rose to about $40, but still under its previous stock price. Then 2021 rolled around and the world started to open up again. The stock rocketed up all the way up to almost $300 per share. See, being prepared for downturns can help your portfolio immensely, and taking profits at the right time is key. Of course, the hardest part of following this crash-proof game plan is tuning out all the inevitable noise from naysayers and perpetual skeptics. You're crazy trying to time the market. This is just healthy profit-taking, not a crash. Why are you hoarding cash while the market keeps hitting new highs? Even some friends and family might think you're off your rocker. It will test your mental fortitude and conviction in ways you can't imagine. But that negativity is exactly what creates opportunities. It's the herd's panic and flight to safety at the lows that allows elite contrarians to pluck up bargains left and right. Ignore the noise and revel in their doubt. It only benefits you in the end. This lays out the key crossing the threshold step of fully committing to the investor mindset and plan. Accepting the harsh reality and letting go of the flawed always buy and hold mentality. Profit-taking is not a bad word. It then provides a thorough overview of the core strategies and actions to take. Ways to hedge and cut risk. How to identify ideal buying opportunities amid the chaos, and how to deal with all the skepticism and psychological hurdles from naysayers. With the battle plan forged in the fires of the investor path, it's time to start executing and making the necessary preparations for the looming crash. First up is strategically scaling out of overheated, overvalued positions, trimming exposure to the riskiest, most speculative corners of the market that are primed for obliteration. Next, we start initiating those hedges, if you are well-versed in options, buying protective put options to limit downside risk, while taking selective short positions to generate actual profits from the bear market's arrival. Remember, options is a very advanced strategy and shouldn't be implemented unless you know all the risks and the ins and outs of buying and selling options. And importantly, we start building up a cache for market downturn opportunities. Stay hyper-vigilant, closely monitoring market indicators and being reactive to all new information. This isn't just a static, set-it-and-forget-it set of strategies. Things like price momentum, volatility readings, put-call ratios, fund flow data, credit spreads. They all give clues as to whether the corrective move is imminent or if the bull still has some life left. Use those signals to dial in hedges and exposures up or down accordingly, dynamically managing our risk to constantly shift with the market's temperament. Flexibility is key. We can't be dogmatic or get caught with our guards down. Stay alert, stay tactical, and continue refining the plan each step of the way. Then one day, likely out of nowhere for the stock market cheerleaders, the crash hits. A massive selling vortex as the precarious house of cards finally collapses under its own excess. It will be a tornado of panic, despair, and capitulation, unlike anything you've witnessed before. A personal crucible where you're forced to go against every single instinct in your being as an investor. The herd will be in full meltdown mode, frantically hitting the sell button at any cost as they helplessly watch their can't-miss portfolio designs implode. The rookie investors will puke their shares in fear, while the grizzled veterans simply surrender to the systemic destruction. Staying disciplined and following the plan, this is where you'll be put to the ultimate test. Your mind will be flooded with uncertainty and doubt. Was I wrong about preparing for this crash? Should I just dump everything while I still can? How much more downside is there? But you'll need to harness every last ounce of your conviction and resolve to stick to the game plan you crafted. You cannot afford to join the herd. Yes, you'll still feel the pain as your portfolio takes damage. That's unavoidable in any crash. But your hedges will be containing the bloodletting, your cash reserves waiting patiently to reinvest on the cheap like a phoenix rising from the ashes. Stay disciplined, stay focused on the predetermined objectives and process, not any sort of distracting price anchors or past highs. Review the data, assess the signals, and execute with confidence when the opportunities arise. The weak hands will continue getting weeded out, but you'll emerge forged into an elite contrarian with nerves of steel, ready for the final reward that awaits. The benefits of having a crash-proof portfolio. For preparing appropriately and sticking to the plan, you'll now bear the fruits of having an actively crash-proofed portfolio. First, by implementing the hedging techniques, you avoided the pitfalls of being overexposed and over-leveraged going into the mayhem. Your capital survived with limited drawdowns versus the sheep blindsided by the chaos. Secondly, you adeptly harvested your weaker positions for tax losses and preserved cash reserves to go on the offensive, rather than being strapped for liquidity like the herd. But the biggest spoils go to those with the moxie to press their bets into the teeth of the crash itself, doubling and tripling down into those fire sale opportunities in quality companies. Your put option hedges sold for massive profits as volatility spiked and delta hedging fueled more downside. Your contrarian short positions in the frothiest pockets of the markets closed out with beer money for years as the get-rich-quick crazes all imploded. And most importantly, your favorite stress-tested stocks with defensible cash flows? You now own chunks of solid blue-chip companies at 50–70% discounts to their pre-crash highs, all while the herd surrendered in the full transfer of wealth period. As the markets inevitably rebound in the aftermath, your portfolio anchored by those well-timed crash buys will be the one minting generational-level gains. While those who missed the sale of the century wallow in FOMO, this is the sweet, well-earned reward for taking the road less traveled as a steadfast contrarian. The miles of discipline and psychological fortitude have all led to this, building a truly anti-fragile portfolio designed to not only survive, but exponentially grow stronger through the volatility itself. As the dust settles from the carnage, you'll begin to notice the market's tone and character shifting. The indiscriminate stock market crash slowly cedes to more rational sector and individual stock rotations. For instance, the S&P 500 starts leveling out and consistently goes up for weeks or months. This is your signal that the worst of the crash is likely behind us, the early innings of the bottoming process before the next bull market can take root. But after being in a full risk-off defensive position, it's not easy to instantly flip that investor bull switch back on. The psychological burn from the crash lingers in ways that can impair decent decision-making. This is where you need to take a minute and reflect on everything you've just went through and remind yourself of the lessons. The stock market is an endlessly cyclical machine, constantly alternating between periods of mania and crisis. There are no permanent plateaus or perpetual uptrends, only the never-ending loop of shifting regimes. You can't get complacent or devolve into bad habits when times are good, because you know another crash lies ahead eventually. Discipline and risk management are permanent practices that must be maintained. Likewise, fortune doesn't favor perma-bears either. At some point, you have to get off the sidelines and rotate back into offense when the market proves itself to be back in a healthy uptrend. Which brings us full circle, back to the rebuilding and continuing to grow wealth after the crash of deploying your freshly raised cash into prime-positioned investments for the new bull market. But this isn't a return to the indiscriminate buy-everything approach of years past. The goal is to remain highly selective, focused only on the highest conviction ideas with innovative drivers in secular uptrends. Maybe it's a new technological breakthrough, a swarming megatrend consumer paradigm shift, or an emerging sector that will disproportionately benefit from the post-crisis environment. Whatever it is, you'll be ahead of the herd in getting exposure to those long-term winners rising from the rubble. Your asymmetric cash management approach from the depths of the crash allows you to be in an early position. And always remember the saying, you only have to get rich once. So make sure to take the profits you made in the crash and put them away in a safer investments, such as high-yield savings accounts or lower-risk ETFs. The importance of continued education and adaptation. Of course, just like we stressed earlier about the precursor signs of excess preceding the crash, you need to keep questioning and re-examining all of your investment theses when the uptrend starts gathering steam once again. Don't fall victim to the same complacency blind spots that doomed you in the previous market crash cycle. Stay committed to continuous education about the ever-evolving market environment. Learn from the processes that were successful and those that failed during the ordeal. Adapt accordingly to fine-tune what worked and discard flawed strategies that got stress-tested. Constantly iterated based on new information and shifting macro variables. You've come to intimately understand that bull and bear, stock market mania and depression, creation and destruction, these are not opposing forces in endless conflict. They are merely two faces of an infinite cyclical flow, a great inhale and exhale that has pulsed through markets since the beginning of trade itself. With this realization comes a settled peace. Gone is the erratic emotional volatility of greed and fear that whipsaws those blind to the true nature of things. You accept the impermanence of any instantaneous state, whether euphoric highs or cataclysmic lows. Both are transient stops along the eternal looping path. The markets call you to surrender to their cosmic cadence, to quit struggling and just be, releasing the ego's attachment to fighting the churning tides, and instead learning to masterfully ride and flow with their patterns in harmony. The mental furnace of watching your portfolio burn revealed what was truly valuable and incinerated all that was not. Attachments to greed, entitlement, and fragile constructs of wealth were reduced to ash on the anxious winds of panic. From that fertile ash, untethered from illusions and false perceptions, emerged a tempered new investor consciousness, an egoless being centered, whose only concern is to commune with the market's cyclical rhythms with authenticity. Those who remain captive spectators observe the markets through a fractured external lens. But you? You now experience them from a transcendent internal space of interconnected awareness, fully aligned with the harmonic hum that sustains all existence, all realities. By staring directly into the abyss of the stock market's most deafening crescendos, you have received the illuminating gift of its cataclysmic beauty, and in this achieved enlightenment, you at last know profound abundance in any occasion.